Investing is a game of chance if you don't know the company you want to invest into inside out. And that's why many investors, such as Warren Buffett or Peter Lynch, probably the two most successful investors of all time, buy into companies based on their intrinsic values. And today I want to show you how to carry out one such valuation called the Grahams Valuation, which Benjamin Graham describes in his book The Intelligent Investor. This valuation calculates the intrinsic value of a company based on its earnings per share and its earnings per share potential. And here we have the Graham's formula. And to carry it out, we have to take the current earnings per share of a company and multiply by the sum of the base PE and the multiple of the growth rate multiplier and the 5-year earnings growth estimate. Then we have to multiply everything by the average yield on AA Corporation bonds and then divide everything by the current yield on AA Corporation bonds. And after that, we will get the intrinsic value of the company we are evaluating. And so now I will take you through how to make these fully automatic valuation spreadsheets step by step in Google Sheets. And by automatic, I mean that when we plug in the ticker symbol of any company up here, for example CVS, all the metrics show up automatically and the intrinsic value is calculated automatically. We can also see the current price of the company and the difference between the intrinsic value and that current price. We can also plug in a margin of safety to find the acceptable buy price of that company. Now, if you want to download these spreadsheets and gain access to the full valuation sheets, which also contains the dividend discount model, the multiples valuation, and the future free cash flow valuation, you can do so at my Patreon, which I will link in the description. Now, the first thing we have to do is to adjust the formula to the current time. So we will delete this formula and put in our revised formula, which instead of a base PE of 8.5 has a base PE of 7, and instead of a growth rate multiplier of 2 has a growth rate multiplier of 1.5. And this is to adjust for the time since the book was written and since the formula was created. Now, the first thing we want to do to start creating our valuation model is to create a cell where we will be plugging in the tickers of our companies. We then want to create a cell below where we will plug in the name of the company we are evaluating. So right now I have CVS. If I plug in, for example, Coca-Cola KO, we want the name to show up right here. And to use this, we'll use the Google Finance formula, into which we have to write the cell into which we input our ticker symbol and the function name. And now we can get to the formula itself. So the first thing we need is the current earnings per share. And again, to get this, we'll use the Google Finance formula and input the cell H3. And using the function EPS or earnings per share, we will scrape the earnings per share. After that, we need the base PE, which is sitting at 7. So we will just simply type in 7. Now the next step is a little more complicated. And that is because to get the 5-year earnings growth estimate, we have to scrape data from the web. And so if I scroll to the right here, we can see the engine. And to scrape the data of the web, the data we need, the earnings per share growth estimate, we will use this formula, the function import HTML. Now I will put all the formulas from this video into the description so that you don't need to copy everything word for word. The only thing you will need to change is the cell number into which you will input the ticker symbol of the company you want to evaluate. And so now that we have imported the data, we can see that here we have the earnings per share growth estimates. The growth estimates are right here from the year 2024 to 2028. And to get their averages, we'll use this formula right here. The average filter is number. And so here we will take the values from 2024, actually not 2025. So if I input that in, that is Y, and we have to input that in here as well. Instead of Z, we will input Y. We will get an average earnings per share growth of 9.16% using this formula. Now we will simply take the cell T16 and input it here. And if you want to be more fancy, you can input in this formula right here, which again I will leave in the description, which basically allows you to have the EPS at 1 if the earnings per share growth estimate is sitting below 0, so negative. Now that we have this, we have to input the growth rate multiplier, which again is sitting at a static number 1.5. So we will input 1.5. And after that, we want the average yield on AA Corporation bonds, which is sitting at 4.4. And finally, we have to get our current yield on AA Corporation bonds, which we will again get from scraping the web and using the import HTML formula. And after getting this final value, we can get to calculating the intrinsic value. And again, inputting this might be slightly complicated, so I will explain at the best of my capabilities. So we will open the bracket and input the cell with our earnings per share. Then we will put the multiply symbol and open another bracket, and we will put the base PE. We will put a plus sign, and then we will put the growth rate multiplier, and then we will put a multiply sign and put the cell with the 5-year earnings growth estimate. Then we will close our bracket and put a multiply sign and input the cell with our average yield on AA Corporation bonds and close bracket. Then we will put a divide sign and divide everything by the cell with our current yield on AA Corporation bonds. And now the Grahams formula revised is complete. So when we plug in any ticker, for example CVS again, you can see that the intrinsic value changes automatically. And now to take it even further, we can move on to calculating the acceptable buy price of the companies we want to evaluate. So the first thing we will need is to bring up the current price of the company. And to do this, we'll again use the Google Finance formula, into which we'll plug in the cell from which we are pulling the ticker symbol. After that, we will have to calculate the difference of the current price to the intrinsic value. And to do this, we'll use this formula. So we will open up a bracket and we will input the cell with the intrinsic value. We'll then add a negative sign and input the cell with the current price, close brackets, and then divide by the current price again. And this will give us the difference. We will then create a cell with a margin of safety, so for now plug in 20%, and then we will create our acceptable buy price, and to do this we'll use this formula right here, and we will input H26, which is the cell with the intrinsic value, negative, open brackets, H26, again intrinsic value, multiplied by the acceptable buy price, so the 20%, and close brackets. And after that we press enter, and we have our acceptable buy price. And now to make it even more fancy, we can add a formula that states that when the acceptable buy price is above the current trading price, it will show up a buy symbol, and when it is the other way around, it will show up a hold symbol. And now let's test our product. So let's plug in Southwest Airlines LUV, and we can see that the intrinsic value comes out automatically. Now we can plug in a different margin of safety. We can plug in, say, 15%, and we would see that we would get an acceptable buy price at $27.40, which would be a buy at the company's current trading price. And that brings us to the end of the video. I did a similar guide to the Peter Lynch model, which you can check out on the screen right now. With that, make sure to leave a like and subscribe, and let me know down in the comments which company you'd like me to evaluate using this model.